Hi everybody, good morning. This is Suchi Runta here, your mentor for E-NCCMP. Can everybody hear me? Please type in a yes to confirm. Can everybody hear me? Good morning. Others also please confirm whether you can hear me or not.
Okay.
Shovik, Taskin. Okay. Surya, can you hear me?
Yes.
Okay. Okay. So good morning and welcome to this webinar. Okay, Surya, thank you. Now, how are your studies going on? Are you watching the videos? Are you all watching the videos? Okay, yes, Sachin. So, how many videos have you watched as of now? Yeah, Sachin, you all can tell me that how many videos have you all watched till now? And then we can start with the doubts which you have had. How is it all going? Okay, so you have covered the entire introductory module videos. Sachin, others, Surya, Shovik, are you all watching the videos? Okay. So let us start a little bit with what has happened in the markets and what is going on in the markets right now. If you all are tracking the markets this week, the market, the results season is on. All the companies are coming out with their numbers. At the same time, there's an important IPO which has come in. You all must have gone through the IPO videos. So the CCD Cafe Coffee Day IPO has come out last week and the issue has closed yesterday. Are you all aware of it? Are you all aware? Yes. So if you all know that since you all have watched the introductory module videos and you have completed the IPO videos, you all should open up the CCD RHDP and evaluate it on your own and then decide whether you should go in for that investment or not. Like I'll just show you the RHDP of Cafe Coffee Day. Here, the CCD video looks something like this. The RHDP looks something like this. And I think you all know what are the important areas in the RHDP to be read. Do you all know which areas to be read in the RHDP? What are the points which should be read if you go through an RHDP? The first which we need to know is the introduction, that what is the company all about, the entire sector. Okay, so we will just discuss that what are the important points which should be gone through if you are looking at an IPO. So the first thing which you should know whenever we are discussing about an IPO is the business model of the company. Let's talk about here. The first thing which you should know whenever you are analyzing any company is the business model. What is the company in two. Second, and the most important, is if the company is raising funds from the public, what is the objective of this fund collection? All the details will be there in the RHTP. So you should know that, for example, if Cafe Coffee Day is raising around 1,152 crore rupees through this IPO. So we should know that in what use will this fund be into, what is the usage of this fund which will be collected, whether it is for expansion purposes or it is for a debt repayment, or it is to fund its working capital needs. The details of the objective of the issue should be studied in detail so as you know that your money is being put to use in what way. That is a very important point which has to be studied if you're going through an RHTP. The third and another important point which needs to be analyzed if you are analyzing an IPO is the management. You should know that what is the management of the company and who is the management of the company, what is their educational background, their track record, their performance of any other group companies if they are holding. If the management of the company is consisting of people who are holding some other companies also, you can check the track record of those companies. You also need to check whether there is any criminal records with respect to this management, any litigations which are outstanding. If you get all that data which is all there in the RHTP, you will be able to understand that what is the management like. The next most important factor which needs to be studied in an IPO is the financials. You need to study the financials of the company, that what is the profitability, what is the EPS of the company, how much is the different ratios needs to be calculated. So the basic financials of the company needs to be studied and overlooked before you invest in any IPO. You can also look for the credit rating agency, that what rating has it got by the credit rating agencies, to get an overview that how the company is doing. So if we just open up this is the RHDP of the Cafe Coffee Day, which is somewhere around like 920 pages, but you need to know which area is to be studied. So the first thing which we will be studying is the introduction part, which will give us a summary of the industry and the business, that is the company business model. Then the objects of the issue is to be read in detail, that why is the company raising the fund, the basis for the issue price, since the issue price is somewhere around 316 and 328, so why, what is the basis of this issue price. Then in this section we have the overall industry review, which we can just go through. Then section 5 has to be seen, which will give the financial information about the company, the financial statements and management discussions. And then there are issue information which we can just go through, that what is the issue going to be like whether it is a book building issue, on what is the basis, what is the lot size, what is going to be the procedure. We can just go through that. We also have a report which has been prepared by the internal students of Credit Academy of the CRTA batch. They have prepared a report on the CCD IPO, which you can have a look on the ELM website, eLearn Markets website, under your IPO as a case study. It's uploaded there, so you can have a look. It is something like this. So they have created a report which has been created after going through the RHTP in details. So you all can go through this and have a view on the IPO. Any questions which you need to ask? Anything? Any queries or any questions which you need to ask? You all can please shoot your questions. Sneha, Shovik, Surya, Shijin, any questions? Any questions from other topics in the introductory module while you have gone through the Okay, so Sachin has a question that what about the risk factors? Now, if you look at it RHTP, the RHTP has a list of risk factors which the company might face in its operations. For example, if we go to page 24, so there are different risks which is involved in the operational business of the company, which is related in this particular section. So you need to check which risk is actually relevant in terms of investment and which risk is just there as a compilation that they have to list these different risks and you can just ignore it while you make an investment decision. For example, one of the risks which the company is stating is our consolidated net indebtedness and our failure to comply with certain restrictive conditions under our loan agreements could adversely affect the financial condition of the results of the operation. Could you please mute yourself? Everybody, could you please mute yourself? Yeah, thank you. So these are the different risk factors which are there. Now over here in the risk factors we can see that there are outstanding litigations against our company. So you should know that what is the amount of litigations which is outstanding, plus how much criminal cases or litigations are against the management of the company, which will give you an idea about the overall management and working. So these are the risk factors which needs to be gone through before you make an investment. Okay? Any other questions? Sachin, can you please unmute yourself and ask your question? Sachin, can you please unmute your question and unmute yourself and ask your question? There is some error here. I'm not being able to view your chat. So can you please unmute your question and unmute yourself and ask your question? Okay. Okay, so Sachin has a question that if it goes within a price band, then how can we calculate that which price is good for it? So actually, the IPO is on a book building process. You need to know whether it is a fixed IPO or a book building process. Since it's a book building process, there is a price band which is given. If there is a price band, the price at which the highest bids are received, that is the cutoff price at which the shares will be allotted to you. So in case of an investment, if you are considering investment on a particular stock, say CCD, you assume that the highest price, that is the ceiling price, is going to be the cutoff price, and if you are comfortable to invest in that particular price or not. Is it clear, Sachin? Okay, so Sachin has a question that he wants to understand that what do we mean by the book building process. Let's come here. Let's talk about the book building process. Now suppose a company wants to issue 1,000 shares. I am taking all arbitrary figures to explain the procedure of book building process, and the price band of the stock is given, say, 50 rupees to 60 rupees. So the price band of the issue is, say, 50 rupees to 60 rupees. Now different bids are collected by the company at different prices, which will remain between 50 and 60. 50 rupees is the floor price and 60 rupees is the ceiling price. So at whatever price you can bid, it has to be between the range of 2, which is 50 to 60. So suppose bid for 100 shares has been received at a price of 50, and say 200 shares bid has been received at 51, 400 shares has been received at 52, 500 shares is received at, say, 53, and bid for 200 shares have been received at 54. Say 100 shares bid has been received at 55. Say again 200 shares has been received at the price of 56, and say then we have 100 shares which has been received at a price of 60. So the price at which the maximum number of shares the bidding has been received is, say, 53. Yes. So this is the price which has been fixed, then is fixed, and all the shares which has been issued after the book building process will be at a price of rupees 53. Now suppose if we add on to this number, it comes to 1100 shares, right? It comes to 1100 shares. And the company wishes to issue only 1000 shares. So 100 shares, 200 shares from here, 100 and 200. All these shares will be allotted shares at the price of 53. Since they were ready to pay a price higher than 53, of course, if they have bid for 54 or 55, 56 or 60, so all these bids would be allotted shares at the price of 53, and 500 shares have bid for at a price of 53. So the rest balance 400 shares will be allotted on a pro rata basis to these 500 bidders at a price of 53. This is known as the book building process, which is actually also known as the price discovery. It helps in the price discovery process, that what should be the price at which the investors are willing to invest in the particular stock. Am I clear, Sachin? That how is the book building process? Okay, thank you. Any other questions with respect to any video of the introductory module? Please ask.
Am I audible?
Yeah, come again.
Hi, Kiran, am I?
Yes.
Yeah. Can you just tell me that who are those people who are involved in this book building process? Means who are those people who are actually making this?
Okay, so the book running lead manager is taking up the entire process. Who does? There are investment bankers who are appointed before a launch of an IPO. Now the book running lead manager, there are a group of investment bankers which are appointed, out of which one is appointed as the book running lead manager. All this process is carried by them. Okay?
Yeah, sure. Okay.
Okay, thank you. Now Pavan has a question. He wants to understand regarding what are mutual funds. Okay, so to start off with, I'll just minimize this. Let us talk about mutual funds. Now let us first understand that how did the concept of mutual funds emerge. If you are considering, say, an investment, there are various factors which you need to understand or which you need to determine. First would be the risk which is involved for an investment. Then you need to understand that what is the return which you are targeting for any investment. After you decide on your risk and return preference, you would then decide on the asset where you need your investment to be. Then create a portfolio of those investments, and then you need to monitor it on a day-to-day basis or periodically to see how your portfolio is running, and then accordingly take actions whether if it needs any changes. Now this entire process needs a lot of time. At the same time, it needs an understanding of the future business prospects. You should be able to know the entire financial markets knowledge which you can apply. You need to know about the track record of the promoters and the business model, which will help you understand whether the particular asset you are considering for investment is good or bad. You need to know about the history of the company, and then a lot of time at the same time to track your portfolio and all that. So many a times all these factors cannot be fulfilled. Either you don't have a time or you don't have the requisite knowledge to do so. So in that case, mutual fund, they offer this investment solution to these investors who wish to invest in the financial markets, but they are unable to do so because of either lack of time or knowledge. So the mutual funds, they are a pool of investments, which is pool of money which is collected and is invested by a professional or an asset management company. Okay, so let me just explain you how does this mutual fund concept work. Say this is an investor. Okay. So these are different investors who pools in their money. They collect small amount of money and they give this money to fund houses. Okay. So this money is being collected by the fund houses. Now these fund houses have fund managers. They appoint these fund managers who they invest this pooled in money in different securities, different assets and different securities. Okay. Now these securities and assets are chosen based on a common financial goal. These assets, when invested, they generate returns. And this returns which is earned by this asset investment is passed on to the investor back. And to do this entire process, this fund managers and the fund houses, they charge a certain commission on the behalf of the investor to carry out the entire process. Am I clear, Pavan? What is mutual funds? Now there are certain advantages with respect to mutual funds. Why mutual fund is considered to be a good point of investment by some investors. The first thing is they are managed professionally. Secondly, because there are a large pool of investors who are investing in these mutual funds, they offer economies of scale. That means since everything is happening on a large scale, you get benefit of economies of scale, and also you can have a diversified portfolio without investing too much of time. So these are a few advantages of mutual funds. Yes, Pavan, please tell your question. Okay, so Pavan has a question that are the returns sure in mutual fund? No. Mutual funds do not guarantee any returns. they are also subject to any kind of market risk, systematic risk or unsystematic risk. You need to read the offer document which is given by these mutual funds, that what are the investments they are considering, and in case if you have that conviction that these investment option would be good, you can invest in the mutual funds, but the returns are not guaranteed by any mutual funds. However, there are certain mutual funds who invest in debt securities which offer a guaranteed return. Say if you are investing in a government security which is guaranteeing you a 10% return, so that particular mutual fund will say that a 10% return on your investment will be guaranteed by us, over and above is subject to any kind of market risk. Am I clear, Pavan? Okay, thank you. So Pavan is asking that are we having a control on the fund houses on which the assets they are going to invest? No, you cannot control the fund houses on which assets you are going to invest in. You are just pooling in your money, and these fund houses or the asset management companies are run by professionals, finance professionals who are running the entire pool of money. You do not have a direct control on these fund houses. But at any point of time, if you want, you can either take out your investment or stay invested. Any other questions? Any other questions? Please ask your questions in case you have any doubts with respect to the introductory module videos. Please ask your questions. Sneha, Shobik, Surya, questions? Sachin, Pavan, Milan, any questions? Please ask your questions. If you have any questions, please ask your questions. Any doubts?
Yeah, I have one question, but I'm not sure that whether it's going to be relevant to the introductory module. I'm just asking it. I am audible, right?
Yeah, you are audible. Please ask.
Can you just tell me the concept of short sell, right? I do not know whether it will be relevant to the introductory module part or not.
It is definitely relevant to the introductory module. I'll just explain you what do we mean by a short selling.
Right. Thank you.
Okay. So now if you are considering an investment, what do? You first purchase a share. Say an investor who is bullish on a stock will first buy the stock, say at a price of 100 rupees, and when the asset price actually goes up, he sells it, right? When he buys this share, when he is buying this share it goes into his demat account, and when the price goes up, say 150 rupees, he sells this share and the share comes out from his demat account. Now this is known as going long on a stock. Okay. Now suppose consider a case where you as an investor is bearish on a stock. You feel that the prices will go down of this particular stock, but you do not have this share in your demat account. Say consider for an example a stock known as Infosys. Say you are bearish on this stock. The price is say 1100 and you feel that the prices will go down to say 900 rupees. If you are bearish on this stock, how can you actually capitalize on that? If you have the shares in your demat account, you can simply sell this Infosys shares at 1100, and when the prices go down till 900, you can buy them back, right? So this is known as a short. You sell them, and this entire procedure is known as going short. Now consider a case where you don't have this Infosys share in your demat account and you still want to sell it. Is that possible? Yes, it is possible. You can sell the shares in the cash market on an intraday basis at 1100 rupees, and in case you can manage to give delivery of these shares to the exchange by borrowing it from someone. For example, say your broker is having Infosys shares in his demat account, or any of your friends is having these Infosys shares into his demat account. You talk to him and you say that, give me, I want to borrow your Infosys shares say for next 5 days because I feel that the prices will go down. So you can sell these shares at 1100, give the delivery from your friend's demat account, and then buy it back at 900 say after 5 days or 7 days. Once you get the delivery of Infosys shares, when you buy it, you can return back these Infosys shares to the person from whom you have borrowed it. On the contrary, suppose your friends do not have these shares in their demat account, you could sell these shares on an intraday basis. You can sell the shares in the cash market at 1100, and before 3:30 when the trading session is ending, you buy back those shares so that you do not have to give delivery of these shares. Another thing which you could do is you can create a position, a short position in the futures market where you can enter into a contract to sell Infosys shares at 1100 rupees on a future date. So you can sell the shares today at an agreed upon price at a future date, and on the future date you can buy back those shares when the price actually goes down and fulfill your contract. So this entire process where you are selling the stock first and then buying it at a later date is known as short selling, and it is not compulsory that you need to have these Infosys shares in your demat account. Am I clear about short selling?
Yeah, okay.
Okay, thank you. Any other questions? Please come up with any other questions if you have. Okay, so Sneha has a question that what is the difference between the transaction period and the interval period in case of a mutual fund? Now, interval period is basically, we are talking when we see there are two categories of funds. We have an open-ended fund and we have a close-ended fund. And we have something known as the interval fund. So in an open-ended fund, you can buy or sell the mutual fund units at any point of time. Whereas in a close-ended fund, you can buy or sell the units at a particular time when the fund is open for investments. It has a particular time period which is known as the transaction period, wherein you can buy or invest in the fund at that particular time, after which the fund is closed for any further new investments. You cannot redeem or invest further in a close-ended fund. So after the fund gets closed, it then trades into the secondary market in case anybody wants liquidation. Whereas an interval fund is a fund where it behaves as a close-ended fund for the most of the time, but at a certain period of the year, say twice a year, it becomes open-ended fund for a period of say 15 days. So for say every January, 1st to 15th January, this interval fund becomes an open-ended fund where you can buy or sell your units. After 15th January till say 31st July, this fund is closed for any further investments or redemption. It behaves like a close-ended fund. Say again, from 1st August to 15th August, this interval fund is open for any further investment, acts like a open-ended fund, after which again it closes. So an interval fund, when you can it becomes open for further transactions, is known as the interval period or the transaction period. Am I clear, Sneha? Okay. We also have a question that what do we mean by the fixed income securities? Okay. So let us talk about fixed income securities. Fixed income securities are basically securities which are debt instruments. We have two types of instruments. We have two types of capital: equity capital and debt capital. So fixed income security basically invest in the debt capital, and there are two kinds of markets if we are talking about fixed income market, which is the money market and the second category is the bond market. Okay. Now, money market invests in those fixed income securities which are normally for a very shorter time frame. They have a maturity which is less than 1 year, and they are extremely liquid securities. When we talk of bond market invests in debt capital which is normally having a maturity which is greater than 1 year, and they are normally dealing in fixed income securities which is issued by the central or the state government or say municipal corporation and government bodies. Okay. So if we talk of money market instruments, some example of money market instrument is the treasury bills, T-bills, which is an exchange traded security. We also have certificate of deposits known as CDs or commercial papers. These are all money market instruments normally having a liquidity of less than 1 year. And then we have the interbank money or the bankers acceptance, which are again over the trade counters trades which is traded in the money market segment. Bond market is again a very, very big market wherein the company or the government issues bonds at a different interest rate, and they are traded. So they are again, but they are normally with a maturity of greater than 1 year. When we are talking of bond markets, there are three important things which we need to study. That is, who is issuing the bond. Secondly, we need to understand what is the interest rate which is being offered with respect to the bond. And last but not the least, you need to know the credit rating of the debt capital or the bond which is being issued. Now these credit rating is offered by organizations like Standard & Poor, which in India say operates through CRISIL, or Moody's or Fitch. These are some credit rating agencies which come out with their credit ratings on these securities. When we talk of interest rate, you need to know whether the bonds which is being issued are fixed rate interest or a floating rate interest bond. And when we talk of an issuer, you should know that whether the bond is being issued by a government or corporate bodies. So am I clear about fixed income securities? Okay, thank you. Any other questions? Any other questions? Okay, so Pavan has a question that what is meant by a face value of a share? A face value of a share is that value at which the share is listed in their balance sheet. The books of accounts of the company will value a particular share at its face value and not at the current market price. The current market price keeps on fluctuating on a real-time basis. So that value of the stock is not taken in the books of the company accounts. So normally the face value of the share is say 10 rupees or 5 rupees, which is the value at which these equity shares are listed or valued in the balance sheet or books of accounts of a company. Clear, Pavan? Am I clear, Pavan? Okay. Any other questions, please?
Ma'am?
Yes.
Just tell about the gold funds, ma'am.
Gold funds. Are you talking about the gold ETFs?
Yes, ma'am. Gold ETFs and gold index and the gold sector fund.
Okay. So now again there are three categories of gold funds, which is gold ETF, gold index fund, and third we have a gold sector fund. Now let's talk about the gold sectoral fund. Now a gold sector fund is a fund which will be investing in all those assets or all those shares of companies which is engaged in gold related business. Say for example Tanishq. Tanishq makes gold coins and watches made up of gold and gold jewelry. So Tanishq is a listed share. So a gold sector fund would be is a fund which will be probably considering its investment in Tanishq. And the NAV of this fund will not reflect the gold prices directly, because the business model is such that yes, it reflects, it is affected by the gold prices, but directly the business operations are not affected. Okay. Now coming to a gold ETF, which is an exchange traded fund, they are normally an open index fund which is traded on the exchange, and you need a demat account to trade on this. Here you can directly trade gold. You can buy or sell gold. It is an exchange traded fund. The exchange has securities which helps you buy or sell gold directly in the dematerialized form. So that is known as a gold ETF. And a gold index fund is a fund. A gold index fund is a fund which is investing in this gold ETF, and no demat account is required to invest in a gold index fund. It is like a mutual fund, and you get your relevant documents if you purchase this. So a gold index fund is a fund which is directly investing in the exchange traded gold ETF, whereas a gold sectoral fund is a fund which is investing in companies which is engaged in business relating to gold. If they are engaged in business related to gold. For example, we can talk of, say, Tanishq. We can talk of Gitanjali Gems. These are stocks which invest in, which is involved in gold related business. Okay, am I clear?
Yes, ma'am.
Okay. Now there's another question by Sachin, that if you want to invest in mutual fund, what should we prefer, growth or dividend fund? That will really depend upon your risk and return profile, Sachin. If you are young and you have a risk taking capacity, you would probably consider your investment in the growth fund. Whereas if you are looking for steady income, then you would probably go for a dividend fund. Okay. Am I clear, Sachin? We also have another question about the foreign capital issuance. So a company can also issue capital from the foreign markets through ADRs or GDR. When a company is issuing capital through the American markets, it is known as the American Depository Receipt. Whereas if the company is issuing from the rest of the world capital, it is known as the Global Depository Receipt or GDR. In this case, the company is actually pledging, giving its shares to a bank of a foreign company, and the foreign company issue receipts, which, say, one receipt is holding bunch of 10 shares, and these receipts are actually passed on to the investors, and they are traded on the foreign market stock exchange. They are known as ADR and GDR. So we have a lot of companies, Indian companies, which is having their ADRs and GDRs listed. For example, Infosys, Wipro and all that. We also have a company, say Rediff company, who is not listed. It is an Indian company, but is not listed in India, but its ADR is listed in America. So it has chosen to raise money through the foreign capital in the foreign markets and not in Indian markets. So that is all about ADR and GDR. Any other questions?
Ma'am, is it necessary that only the American citizens has to invest in the ADRs?
Come again, I could not hear you. Could you please repeat your question?
Is it a compulsion or a necessity that only the American citizens can invest into the ADRs?
Yes, because ADR is receipts which is issued in the American markets. Okay?
Okay, ma'am.
Yeah.
Okay, ma'am.
Any other questions, please? Okay, Sachin has a question that it means we could get a better return in growth fund rather than dividend fund. Return wise, yes, definitely growth fund would offer a better return but you have to keep in mind the risk. A growth fund will always have a larger risk component attached compared to a dividend fund. So you need to balance out both your risk and return. Obviously, if you take in higher risk, the return targeted is higher. A lower risk taking is targeting a lower return. So if you have that risk appetite of taking a larger risk, you should go in for a growth fund. Clear, Sachin? Okay, thank you. Any other questions? Please ask in case if you all have any doubts. Pawan, regarding growth stock and value stock, I think you can ask these questions in the fundamental webinar, which is more related to the fundamental module. Wherein it could be explained with details that how do you identify a growth stock and what are the factors which you need to check on the growth stock and value stock. Thank you. Yeah. So, do you all have any other questions with respect to the introductory module? Please ask. Okay, so with this we come to the end of this introductory module webinar. You all please keep on watching the videos. We will have a separate derivatives webinar, Pawan, wherein you can ask in all your questions and queries with respect to the derivative module. Okay. So with this, we come to the end of this webinar. Yeah. So happy studying till then. Keep on watching videos. In case you have any further queries apart from the webinar, say, so you all can post your questions also in the community section of the e-learn markets, and we are there to answer your queries in detail apart from this webinar. Okay. Thank you everyone. Happy studying. All the best.